In this chapter, we want to take a closer look at the topic of market phases. Market phases are a rather theoretical construct that we often find difficult to apply in practice, which is why many people often leave them out completely. However, I would like to talk to you about it anyway, because it can have some really important effects on your trading. Because only if you are able to really recognize the market phases will you be in a better position to decide when which setup makes sense. And the ability to recognize this alone makes you significantly more profitable, because you are able to stay out of the market because you recognize that this phase does not suit your system. Every trade that has a bad probability but which you skip because you are aware of it is a trade that saves you money. So here's a quick recap of what market phases there are. First, there's the accumulation. Then there's the uptrend, then there's the distribution, and then lastly, there's the downtrend. The accumulation always means that positions are being built up there for a long push. The uptrend is very clear, the market is in a strong long trend. Distribution is always when the market slows down and the order flow shifts from either long to short or short to long. Also, the strong uptrend from before ends here. At the end of a distribution, there's often a downwards trend. However, it is important to note that a trend phase do not always have to be the same length. A market that is long on a larger time frame can have a short trend after a distribution before we return to a long phase again. In other words, the phases do not always have to be the same length. It is important for you to be able to recognize the phases in practice. That's exactly what we go into again now. We start with phase 1, accumulation. This is characterized by the market building up a kind of range and sweeping this range from time to time. It may well be that you experience the first small rally here already, which is then swept again. This is really about the big players building up their large positions, and they need us for liquidity, which is why it's important that we do not enter the market too early and aggressively. A typical accumulation phase is really something like this. It often starts with smaller ranges. We also see first rallies here, but they are countered fast to the bottom again. This is a light sideways phase here on the 4-hour chart. We don't really get any lower lows here, but we also don't move higher than the top of the range here. It is a market phase that is characterized by the fact that we are moving in a rather narrow price range and we are moving sideways a lot and are not moving so impulsively and making any huge movements. Rather, we tend to run along the upper side of the range, then back down again, then we go back up again. There's a lot of redistribution here and large positions are being built up. These are phases where we have to scale back our profit expectations. When we enter into setups, we have to think very carefully about where the market could go, and we cannot expect any big breakouts here because the market is still in the phase where it is redistributing money and building up the large positions. This means we try to take small movements here and small profits. In this example, we see liquidity sweeps at the end of the range to the bottom. This is a sign that large positions are being initiated by the big players here, continuing an upwards movement after. But to that we come now. The second phase is the uptrend. This is actually where we can make the most money and we have the easiest setups here. After this range, for example, we see we swept the liquidity on the bottom. This means very large long positions were being established down here. And afterwards, we see a break to the top of the range. So we have our internal break here. After this break, the phase 2 is confirmed in the market, basically. So what can we do here? After this break is initiated, we can enter long in the market with each retracement there is. We can also wait for a retest of this price area, which happens later, and we see upwards movement after. Basically, we just wait for retracements and enter them. These are the easiest setups for us. We can see that the market has formed a range here and has simply gone straight up from here. This is where power plays come about in trading. We have several entry opportunities here, and the big money has shown us already that they want to go long. So we are moving in the same direction as the big players. This means we are certain that we want to be on the long direction in the market. Such a trend normally ends in a distribution. We find the distribution at the end of an upwards trend. The distribution is kind of the same as an accumulation. Here, the money is being distributed again, and the order flow shifts from long to short. So, short positions are being built up, and long positions are getting closed, and profits are being taken. We could stay in this example here. Here we see this could be a distribution. A distribution often looks like this. With extended sideways areas here again, every now and then a push upwards, which then sold off again. We're already seeing structural break to the downside, for example here. In other words, distribution accumulations are basically the same thing, except that accumulation results in a long push and distribution results in a short push. In phase 4, we are again in a strong trend then. We could take this as an example as well. After enough money has been redistributed, we have ended a downwards trend and the market went lower and lower. Here we have our power plays again, because we can trade this very strictly and easily. You can make a really good profit here, and there are plenty of setups. To sum up, we have to recognize which phases we are in. If you have an accumulation, we tend to be in the narrow range and don't make big trades with high expectations. If we have a distribution, it is the same scenario. And in these two phases, we simply have to leave out certain setups and generally be more relaxed in the market. We don't have to take a trade every day. In contrast, we have the trend phases, where we have the best opportunities. Here, we have our setups where we can earn really good money and there are enough opportunities to get into the market with a trade. It is simply important for you to be able to distinguish between these market phases. That's why you should simply pick out a few markets and try to determine the market phases yourself. Of course, it is always easier to determine the market phases in the past than determining the market phases in the present market. First, you should take a look at everything in the past, figure out which market phases are valid, and then we look at the future again later in the course when I present the setups to you in concrete terms.